Good morning, everybody. My name is Lezama Schneider. I'm actually a principal at Red Alpine. Red Alpine is a multi-stage VC. We come from the early stage side. That's where our heritage is. But we also have an evergreen growth fund. And I'm responsible for sourcing and executing of growth equity investments. Today, what I would like to present is actually how we believe we actually contribute to making private tech investments more accessible and also more flexible, and that we actually see a general change in the entire industry. So this is a little bit the part that I want to talk about. In general, the private market opportunity when we go into evergreen funds and also particularly closed-ended funds versus the evergreen model. And when we tell you how we actually approach this and why we see an opportunity in this market. What you see here on the left-hand side is that essentially over the last 30 years, the number of publicly listed company has halved. And when you look on the right-hand side, what you actually see is that companies with over 100 million in revenue are mostly private. In the US, in fact, 87% are private. In Europe, it's even more with 96%. So what this basically tells you is that if you want to take advantage of that opportunity and the value creation, the private markets are broader and actually deeper as an investment universe versus public markets. And I think this slide actually easily illustrates that. So when you look at the red dot, that is actually the company founding point. The dark blue point is the point at which the company is actually IPOing. And when the light blue point tells you when the company is reaching a valuation of about $10 billion. What you see actually 30, 40 years ago, that the company stayed basically not so long actually private, and there was a lot of value generation in the public markets, particularly when you look at Adobe, when you look at Autodesk, when you look at Electronic Arts, right? So companies quite quickly IPO'd, and then a lot of the value creation until they reached 10 billion valuation actually was done in the public markets. When you look what happened actually more in the last 2 decades, that's very, very different. When you look at, for example, the Dropboxes, the Zalandos, the Ubers, the Lyfts, and the Robinhoods, you actually see that most of the value creation is in the private markets. And in fact, some companies actually IPO after they have already surpassed a $10 billion valuation. So you see this, for example, with Snap, with Robinhood, with Lyft. And this means really, if you want to take basically part in this value creation in the private markets, or in general in generational companies, you need to invest in the private markets. That's just a little bit of a teaser in terms of the pace of innovation that we have seen, right? So when you looked really 50, 60 years ago, right, the pace of innovation was way slower. Took sometimes decades for a big leap in innovation. But what you have seen really from the invention of the World Wide Web, over the sequencing of the DNA, the social media mass adoption, particularly by the launch of Facebook, and then obviously the introduction of the iPhone, when the breakthrough of OpenAI in 22, and then actually the launch of the SpaceX Starship in 23, that the cycle of innovation becomes always, it's not a decade anymore, it's really years, right? And now, obviously, with Gen AI at the forefront of what we see actually in daily innovation is that we actually expect more and more innovation in the coming years, right? So the cycle, the pace of innovation has substantially increased. To basically take a step back, right, and to show you really the entire ecosystem, how we think about pre-seed investing up to really IPO, what we define as venture capital is really seed, so early stage investing, which is usually seed, Series A, and then growth stage investing, which is usually everything from Series B until shortly before the pre-IPO. And obviously, the more mature a company becomes, the more it goes into the buyout category, and at some point, the company usually becomes public, right? And where we really believe in is that venture capital is really the key driver of innovation. When you look at traditional buyout targets, it's really, really good companies, often market leaders in niche industries that basically generate good cash flow. But when you think about the venture capital industry, what is currently being backed is the generational companies of the future, the Microsofts, the Apples of this world that are actually VC backed. And you actually see this with the numbers, right? When you look at the venture capital that has created the backbone of our global economies, 50% of the total number of US companies are actually VC backed. 77% of the US market capitalization is by VC backed companies, and actually over 90% of the R&D spending and the patent value is generated by companies that at least at some point were VC backed. And this is exactly my point with generational companies. When you look at the VC financed companies in the 2000s, the Intels, the Microsoft, and obviously when now actually most of them are really VC backed, right? The Apples, the Nvidias, the Facebooks, the Broadcoms, the Teslas, the Amazons, and the Googles. And what VC is literally financing right now is the generational companies that you will see in the next 10 and 20 years, right? The new Nasdaq, the new S&P market leaders. And that's really on the late stage growth equity side right now, and some a little bit earlier, but that's really what venture capital is doing, the next generation of innovation and innovators. When you look at a little bit at the performance, right? What you also have seen over the last years, and that really reached from the last 20 years over the last 5 years, is that VC has consistently outperformed public markets. What you see here is actually in red is the European VC index, and in gray is the MSCI Europe. And you actually had a smaller differential over the last 20 years, right, of about 6% between VC outperformance over public markets. But that differential has significantly increased, particularly in the last 5 years, right, of 20% versus 8%, so a 12% differential. Obviously, everybody is talking about the US, geopolitical tensions, etc. And we actually really believe that this right now is the moment of Europe to shine, particularly in terms of innovation and particularly in terms of venture capital. And why we believe that is actually quite well shown on this slide, where you actually see that of the 10 most innovative countries in the world, 7 are actually European, right? With the exception of the US, South Korea, and Singapore. Particularly, Switzerland is the most innovative country, right? And you see this also when you look at the stats in terms of founders. 14,000 founders have started new companies in Europe in 23, which is actually more than in the US. You have the top 5 universities in engineering and tech actually in Europe, with Oxford, with Cambridge, with École Lausanne, with Imperial, right? And then you have actually even more developers in Europe than in the US, which is actually about 50% more. So we think actually when you look at the basis is so strong in Europe that we actually will or expect a lot of innovation in the coming 10 to 20 years, particularly out of Europe. When you look at the unicorns, or at the number of unicorns created by the dollar invested, what actually is quite surprising is that actually in Europe, it's as many as in the US. So we are definitely not lagging behind in Europe. And then I actually really want to talk a little bit about the entire ecosystem. So what is really happening in Europe is that the entire ecosystem is really maturing, right? And you see it really what has happened in the last 10 years. On the early stage side, you had essentially about 8,000 companies, which is now actually 35,000, right? Over 4 times as many. On the late stage companies, you had 10 years ago 450, and now it's actually over 3,000, which is over 7 times as many. And then in terms of unicorns, they actually 5x'd from 70 to 360. And you see this really in the select category leaders that we also point out. Some of them still private, like the Revoluts of this world, like the Mistrals, right? But some of them also public, right? Like Spotify, like a Klarna. And we also want to really also show that there has been quite a strong exit record over the last 10 years. So the exit volume actually 2.4x'd versus the previous decade. And you had actually over 160 unicorn exits in the last 10 years. Obviously, the case for Europe is clear, but what is actually way more important, and obviously also with Switzerland being the most innovative country, is that Zurich is actually really the hub of innovation, which we actually personally see at our firm with the companies we are actually backing, the Forges of this world, Switzerland-based, really R&D innovation, particularly on the robotics side, but also on the AI side. You see a lot of innovation that is actually happening right now. So recent offices have been opened by Anthropic, by OpenAI, and also by the Robotics and AI Institute. And obviously the Apples, the Metas, the Googles of this world, the Nvidias have significant headcount here, and particularly focus their R&D experience and headcount actually in Zurich. So we actually see Zurich as the forefront of European innovation right now and in the coming years. Also, this is why you actually see that what a lot of people actually don't know, that European VC has actually outperformed US VCs on a percentage basis when you compare USD performance. So in the last 20 years, the US was still slightly at 12.3 over versus 11.8%. But that actually then basically went over the last 15 years on par. And in the last 10 years and last 5 years in particular, actually, Europe has been starting to outperform US VC returns. And now I want to quickly come to evergreens, because what actually a traditional venture capital fund really entails is basically a closed-ended lifetime of usually 10 to 12, sometimes even 10 to 15 years. Capital is usually drawn over 3 to 5 years. An investor has basically to commit upfront a certain sum and basically hold the money back for capital calls over the coming years. Net returns can be actually initially quite negative, particularly during the J-curve times. And obviously, the distribution comes significantly later until you actually see money, usually more in the years 5 to 12. And that's basically how the net asset in value basically evolves. And at some point, you basically need to start again if you want to reinvest, right? And obviously, you have a lot of vintage exposure. When you put side by side an alternative model, a model that has been quite visible actually on the private equity side, but less so on the VC and growth equity side, is the evergreen vehicle. And what this means is the fund is open-ended, so theoretically doesn't have a fund lifetime. Investors can usually subscribe on a quarterly basis, and you usually have actually liquidity windows, right? Usually every year, sometimes even every quarter. So essentially, this allows you to define your own holding period. What is also super important is that you don't need to basically commit a certain amount and hold some money back for future capital calls. you can invest as much as you actually want to invest. And that amount compounds until you want to basically take advantage of a liquidity window. And what this really allows you, and the key difference is really that you can take, or you can compound in terms of innovation on the VC and on the evergreen side. Yeah? And this is why the net asset value basically is compounding and compounding. You don't take vintage risk. You can really invest over cycles. And now the question is how we actually approach this. And maybe I give you a little bit a background of Red Alpine. So Red Alpine is a Swiss multi-stage VC. Our headquarters is in Zug. We have also an office in Berlin. We have an office in London. I sit in our London office. And we have one general partner that is actually in Silicon Valley. We are around for 20 years. We have actually 7 funds on the early stage side. That's where our heritage is. And we have a global growth equity focused summit fund, but that summit fund really is an evergreen fund and spans everything from early stage until pre-IPO. And when we are actually in the process of raising currently our closed-ended growth fund that will be Europe only and will focus on Series B and Series C investments. And what you can see is really that over time we really try to be very consistent and very disciplined in terms of investments. So that has resulted in average TVPI of 3.6 times with a pooled IRR of over 22%, which actually made us being awarded top 1% in EMEA by Deal Room. And now our AUM stands at over 1 billion Swiss francs. A little bit as a background on Red Alpine, right? What the heritage really is connecting software and science. Our 2 founding partners literally illustrate that. The one is a software entrepreneur, previously IPO'd his company, and the other one is a previous scientist, a molecular biologist. And that's also reflected in the entire team. So very multidisciplinary. Half the team is scientists, and the other half is literally operators, and some also with a corporate finance background. We are active since 2006, so by far one of the most active VC investors in Europe, particularly in Switzerland. We backed actually over 100 companies since our start. And obviously what we really illustrate is, or try to illustrate, is Swiss values, right? Precision, quality, reliability, honesty, and obviously a significant emphasis on entrepreneurship. The companies we back range from industries like robotics, fintech, can be also B2B SaaS, particular cybersecurity, AI and automation, health tech, pharma, biotech. And what we have really as a heritage is a deep tech focus and a focus on what we call a tech hedge, something that gives the company a moat in technology advantage, right? So that it cannot just be easily disrupted. And we make sure that the same emphasis is really in our team, and that also the companies we back have a positive social impact. And this comes a little bit to how we source, how we actually create value, and what this actually results in is actually our track record. But obviously our heritage is the early stage side. So the advantage this really gives us is that of all the companies in Europe that raise a seed or Series A round, we see over 80% of the companies. And even the ones we pass, also obviously the ones we sometimes miss, we actually continuously track. So this gives us basically a data mode in terms of actually continuous performance of these companies and tracking these companies to see why some companies actually make it and others don't, and also we can take advantage later on with our later stage vehicles. What we really focus is creation of value, right? We are not a passive investor. We have a dedicated value creation team, particularly headed by somebody that was formerly very senior at Uber and Google. And what we really try to is help the company execute on their expansion, both on our product side, obviously on their geo side, and we actively also help manage the exits. And that might be in good economic climates and good markets, but also in less good markets, to basically continuously also create DPI for our investors. And obviously, with this early stage heritage, this really positions us also quite well for the upcoming closed-end growth fund, and obviously the Summit Fund as an evergreen fund. Okay, I think we have a little technical problem. Perfect. So back to that. So, and as I alluded to already, on the private equity side, evergreens are already mainstream, right? Obviously in Switzerland, everybody knows about Partners Group, and in Europe about CVC. In the US, you have the Blackstones, the Ares, the Apollos, the KKRs that have basically made evergreen funds already mainstream, and a lot of other actually investment managers and asset managers. But on the growth equity and venture capital side, that's less the case, right? Very few managers have actually come up with evergreen funds, because what you really need to do that is a consistent track record and a real focus on asymmetric risk-return profiles, particularly not taking too much risk, but also having significant upside still. And there are some funds that have global products, like a Sequoia, like a Ribbit, and like a Stepstone. But we are actually really the pioneer with a European-focused evergreen product that covers everything from seed all the way to pre-IPO growth equity. So what is this really, the Summit Fund? Yeah, Summit Fund is geographically European focused. Yeah, usually we would say 5/6 of the entire fund is European. We also focus a little bit on global category leaders, obviously to have that in the mix. It's a sector agnostic product, even though we have certain verticals that we have quite a lot of exposure to, particularly fintech side, particularly B2B SaaS side, particularly also the automation side. The long-term target is 1 billion Swiss franc alone, due to performance and obviously continuous fundraising. And what we really try to create with this product and try to always refine is a one-stop shop solution for particular private wealth side and the high net worth individual side, so that it gives basically individuals access to the entire innovation ecosystem from seed to pre-IPO, right? So that you don't need to go to the secondary market and try to buy some SpaceX shares, because actually the Summit Fund has a position in SpaceX or Robinhood or Mistral, right? Or the tax fixes, the Hilos, the 9fins of this world, right? It's a semi-liquid evergreen structure. We have actually quarterly investment windows, and then yearly redemption windows after an initial 3-year lockup. So what this really allows you is to define your own holding period, your own investment period. So when you need liquidity, you can actually have the liquidity, and it really gives you way more flexibility than a closed-end product where you actually commit now and see maybe money in 6, 7, 8 years and need to be staying invested, and you also have the vintage risk there, which we are actually not taking and are quite diversified. Obviously, sounds great, yeah, but how do we actually achieve that? Because it's actually not that easy. And how we do this is by focusing on 3 investment pillars. Each is about 1/3 of the overall investment commitment. The first one is our fund of fund side. So what we invest here is our early stage funds. So we have already invested in RAC 7, which is the last early stage vehicle we had raised. And actually, we are also writing a ticket in RUC 8, which is the newest vintage that we are currently actually closing. Final close is around the corner. And then we have also our growth and fund that we are literally raising right now, where we also write a ticket. And what this gives you, pillar one, is really a diversified exposure to different vintages, to different maturities, and different sectors, all in this one vehicle. And obviously, these are closed-end funds. So what actually the fund is doing, we write a certain commitment and then serve these capital calls. But what it allows you to do is you actually just invest and you are exposed to these different funds, but you actually only invest how much you want to invest, and we basically take care of the capital call serving essentially inside the Summit Fund. So that's the first pillar. That's about 1/3 of the commitment. The second pillar is our portfolio superstar vertical. And what we here focus on is the creme de la creme of our early stage companies that have reached growth stage. And what we do here is we re-underwrite the company from a growth equity standpoint, and only if really positive, then we double down directly. A good example is actually what we did with 9fin last summer. 9fin is the Bloomberg of debt, essentially a data services provider focused on the debt market. And the company was performing so well that we really went into the diligence with a 50-page long IC memo, significant diligence reports also from the last lead investor of the Series B, and we were able to buy shares from early investors in the company at quite an attractive valuation. Company is doing exceptionally well. Similar situations we have actually taken advantage of on cases like an Hilo, which is cuffless blood pressure monitoring, and TaxFix, which is essentially a digital tax assistant. And obviously, we're adding more and more, right? And where we really have this advantage with our pipeline from the early stage companies, and we have the front row seat to really see which one is performing and why. And obviously, then the third vehicle or the third pillar is really the category leader vertical. And we are here very focused on European category leaders, but we also are open to exposure to global category leaders. And what we are really focused on is generational companies. Companies that will change the world we are living in. So we have, for example, a big position in SpaceX, and we have also a position in Klarna. We actually bought this at a very appealing valuation in the private markets less than 2 years ago. We still have actually shares in Robinhood. We were a private market investors in the company and sold most of our position, but still have some shares in the public markets. And obviously, we are also a backer of Mistral, which is basically a competitor in the large language model space, the European sovereignty bet in that vertical versus an Anthropic and an OpenAI. And basically, when you think about these three pillars, that all by itself, each by itself is already quite strong, but together it gives you really this exposure from early stage venture capital exposure, but on a diversified basis. So you don't have single venture risk exposure, but really diversified with a manager that has been doing this for 20 years and consistently performed, until really the late stage pre-IPO bets, both on Europe as well as the US. So just to give you a little bit of the outline on the closed-end fund sides, what that actually really entails is, and as I already had illustrated with the closed-end fund example more generally, is that this is a vehicle that has usually a fund lifetime of at least 10 years, 10 to 12 years. This is our RUC series, so the early stage venture series. It's focused on seed, Series A. It's sector agnostic, European focused, has 18 to usually 20 portfolio companies. So it's not a spray and pray model. It's really a highly concentrated portfolio on the venture side. And it really only backs seed and Series A. When the closed-end growth fund, and that is more a lead vehicle versus the Summit Fund being more a co-investment vehicle, is really focused on Series B investments, particularly on the lead side, and the Series C side more on the co-investment side. We are also very sector agnostic. The portfolio is even more concentrated, usually 10 to 12 portfolio companies, and the duration is usually also 10 plus years. And this is a little bit gives you an idea of actually what we had in our portfolio. A lot of people that have heard about Red Alpine know obviously that we were the seed investor in N26, but there are actually also quite a few other companies that have basically made it to the unicorn status or are literally on the verge to becoming new unicorns in the coming months. Yeah, and you see this literally across our fund generations, which have actually very, very interesting companies. And obviously, the unfair advantage we are having is we usually have a board seat or at least a board observer seat, even if the company progresses through its maturity cycle. And obviously, we have followed the company for a very long time. We know literally why there are certain catalysts and if it actually makes sense to buy potentially secondary before an upcoming raise. So we might be actually able to enter at a better valuation than other outside-in investors that come in later in the companies. On the category leader side, what we are really focused on is companies that will continuously compound over the coming years, right? These are usually companies that have very limited downside risk over the mid and long term, at least after we have done our diligence and are sure about the moat, but substantial upside. Usually very strong founders, often European heritage when we do a bet, and the market is really usually quite appealing and ripe for technological disruption. And this is really what we are focused on. In terms of our portfolio, what this results in is a little bit overall what we try to do in the midterm is a third. So you have basically fund exposure a third, you have portfolio superstars a third, and you have category leaders a third. Currently we have a little bit less on the fund side, but obviously more is coming to that. And we always leave a little bit of cash balance, but we manage this actually very, very disciplined to basically serve potential redemptions, etc., and obviously leave always dry powder for good investments. But what we can also time very well is when we actually want to exit a company, which oftentimes, particularly on the later stage bets, is possible without a public listing in the private secondary markets. So if we see a really good opportunity that we would like to take advantage of, obviously we have our capital inflows, but on top of that, we can also dispose of some of the investments in the secondary market and actually double down basically on the other opportunity where we see actually a better asymmetric risk-return profile. In terms of sectors that we have been historically very focused on is certainly fintech. Yeah, it has been certainly our fintech heritage. We have been investors in 9fin, we have been investors in N26 over time as a company. We have been investors in TaxFix, and we are actually looking at more and more of these companies. Obviously, portfolio is already quite fintech heavy, so we are trying also to focus on other verticals like more mission critical B2B SaaS. And obviously everybody is currently super nervous about AI disrupting the entire SaaS market. We actually think still they're really vertically integrated players, and the ones that are really ingrained in the workflows are not getting disrupted. But obviously we are very valuation sensitive. So what nobody wants to do is paying basically a high private market valuations and getting a low public market exit valuation. But it's still a very interesting sector for us, but we are very disciplined on that side. We will certainly add more in the future. We have had quite a bit of exposure also to marketplaces, and then otherwise we are also really looking on the AI side, but in a responsible way, right? That can be, for example, the large language model frontier, where we have actually been backing Mistral for a while, which is doing actually very well now. We also looking more and more into the application layer, but we thought it takes actually a while to really see which ones are the champions. Yeah, And the third one is certainly we are taking more and more look into the AI infrastructure layer, where we see also very interesting place. What this really results in is in our portfolio. These are basically our top 10 positions. Obviously, it's 9fin, Hilo, still Klarna, Mistral, RAC7, which is the last early stage fund generation. We have also Sender, Show Heroes. Now, actually, one of the largest positions in the fund, actually, with later this quarter, the largest position in the fund is actually SpaceX. We have actually backed the companies 4 years ago with actually a small ticket, but actually has compounded very, very well. And that's literally how we think about the fund, right? 5/6 usually is going into European companies, but when you have these outlier category, global category leaders that will still compound and where we want to give our LPs exposure to, the SpaceXs of this world. And then we have also obviously companies like the TaxFixes, the ZenJobs. So what this product essentially really gives you is access to European VC in a single product. So you don't need to go to different fund managers, go into different closed-end funds with different vintage risks. You are really diversified from seed all the way to pre-IPO. You have immediate exposure, right? You have an existing portfolio that you get exposure to. You don't have a blind pool, essentially, like in a normal closed-end fund where you invest your money, but actually the fund is still to do investments. You have here already an existing portfolio that will be continuously complemented by other interesting and appealing investments, in our opinion. And obviously the structure is semi-liquid, where you can really decide your own holding period. Yeah, can be anything from 3 years up until forever, right? As long as you basically wanna take advantage of compounding in the economy, in the innovation economy on the VC and growth equity side. And what this also is actually quite a bankable and investor-friendly solution in the way that you actually can put this in your bank depot and actually have everything at one place. And what I also maybe quickly want to mention is basically the two verticals we are really focused in terms of distribution are with our private wealth partners. We have actually 3 partnerships with Maike Baumann, with Reichmuth, with Schweizer Kantonalbank, and are obviously continuously expanding this, and obviously high net worth individuals directly can also invest in the fund. We have also a little desk here, so everybody is obviously very welcome to stop by and talk about the Summit Fund, the closed-end funds, be it early stage, be it growth. And actually for our investors, we also offer actually select co-investments in individual opportunities that become later available. Yeah. So I would love to open the dialogue with you for questions. So anything I can help answer, please let me know.
Sorry, I go again. What's the valuation methodology for underlying assets when someone wants to redeem? If we see what happened in public markets, for example, HubSpot, a leading company, it's I think 70% down in the last year. How frequently do you do that, and who does it? And I think this is critical. I'm sure this is an expected question, right?
Of course. It's super important for us. Actually, we have a quarterly portfolio review, which I can tell you is very workload heavy, let's say it, right? Because we literally go through the entire portfolio, what has actually happened versus the last quarter, and we mark to market every position, right? So obviously the base case is usually, first of all, the last round that has recently raised. But obviously if this has been a while ago, or if something material happened both in the market, like you just mentioned, or actually idiosyncratic in terms of company performance, then we will definitely adjust the valuation. I can just tell you in 1 month we have the next portfolio review, and it's always a lot of work because we are very, very diligent, but this is what is actually required for this product, yes.
Do you disclose the methodology in a way, or is there any way investors can see how you do that and who governs that, or it's just internal and you decide how to do it?
No, so I mean, obviously we have our fund administrator, but it's the entire investment committee and the investment team that sits there in a room and discusses every position in detail. And after that, we communicate this obviously to our recommendations to the fund administrator, which in the end makes the last decision. And we have obviously quite an extensive reporting in the Summit Fund in terms of also our NAV by company. So it's not just a blind box where you just know the names but don't know the exposure. And I can just tell you, I would always ask every fund provider that you even consider any investing on the evergreen side how they do that, because I think actually my colleague said this to me. The more the investment team is worried about the upcoming portfolio review because it's that painful, the better it's actually marked, because there's so much work going into that. Sure.
Could you share a bit more on the follow-on investments you make in the two buckets you've been talking about? You were mentioning in certain cases the private companies you cover, it's the portfolio companies or they're outside of Red Alpine. Could you share a bit more color of examples you've been able to do? And you were mentioning also you sometimes are on the board, right?
Yes.
Or advisory board. So out of your portfolio companies, how many are you on the board? And follow-ons, how's that been?
Sure. I mean, I think a good example is Knife, and the one I actually alluded to. In the company, we are actually the largest investor. The company, actually we led the Series A in 2021, and the company was doing so well that we actually took last year advantage of buying secondary shares from 6 early-stage investors and consolidated the capital, which actually made us then the largest investor in the company. Company is performing tremendously. We have still a board observer seat, super close to management. Just FYI, Red Alpine Group owns over 15.5% of the firm, right? So we are not a passive investor. We're really substantial, also on a VC scale. And similar examples are, for example, the high-lows, the tax fixes, and obviously we look also Carvolution. We have, for example, also in the portfolio. Inkit is another one, which is essentially the Disney of the 21st century. So yeah, that's what we do on the portfolio superstar side. And most actually, on most examples, we are either board observer or have a board seat. And on the category leader side, what we always look for is usually the number 1 player in the market, sometimes also the number 2 player, depending on price and if we see a particular lot of catch-up opportunities. Obviously, we look fundamentally if the market is attractive or not, and if it compounds, right? Focus is certainly on Europe, but obviously we are also open to the category leaders like the SpaceXs, right? SpaceX actually was not a rocket launch bet. It was really a communication bet, right? Because of Starlink, that this will be really the communication infrastructure of the future, and itself is actually quite cash generative and will basically finance the other moonshot bets, like a bet on the space economy, on data centers in space, etc. And that actually worked out quite well. Klarna, for example, I can also give you a good example, is quite a asymmetric risk return bet. We actually invested in the company after the down round, when basically the company's valuation had cratered from 47 billion to under 7. And we literally had passed at the 47 billion mark. But at that point, the company was outperforming its key peer firm significantly, has also actually a more resilient business model, which is more focused on a take fee or merchant fee than interest rate model. So will be more resilient throughout a cycle. And we took advantage of that. And that was 2x into the IPO already. Obviously we think about how to protect certain positions, but this is really what we do, right? Both valuation sensitivity, but we also look for really long-term category leadership in the European and global scale and global market.
Just maybe one short question. What is your process for selecting new companies into your portfolio? Like, do you actively go out there, or do you have companies approach you and say, hey, want to invest in us?
That is actually a mixture of both. Yeah, you can imagine the SpaceXs of this world is a little bit more tricky when some European companies that already know you as a Red Alpine, right, where you actually need to go out. So we are active on both fronts. So the thing is, in Europe, we are very, very established. So we have a lot of relationships already from the early stage side, which we can obviously double down on in terms of the Summit Fund. And what a lot of actually companies really like is that we can start investing on the early stage side, but we can really go until the super late stage side. So we can be a partner over time. We don't need to go to our basically investors and can basically take capital from us. And the more we scale, obviously, the more that advantage actually compounds. Having said that, we have basically our key industry verticals that we are very focused on. We have a target list. It's usually currently about 100 companies where we actually prioritize with the highest priority, middle priority, low priority in certain verticals. And we have active dialogues with many companies, because what we can take advantage of is not just primary investments. We can also buy into these companies at a secondary stage. And that is really a competitive advantage, because there are oftentimes a lot of early stage investors that would like to have some liquidity, or early stage long-time employees that actually would also like to see a liquidity event. And obviously, at some point, or sometimes, you have a good chance to actually get a better pricing in the secondary market, particularly before a new primary round, that a valuation uplift could happen, right? And we can do this by direct secondaries, but we can even do this by GP-led or LP-led secondaries to get exposure to, for example, a fund vintage that is 95% SpaceX. Yeah. So that gives us really, really competitive advantage. And in Europe, and I see it really on a daily basis, very few people are doing this. Yeah, it's usually the US funds that actually are able to pull this off, but in Europe, it's actually barely anybody.
Thank you for the presentation. So on the Summit Fund, can you talk a bit more about the structure of the fund? I saw it's a Luxembourg.
SICAV RIFE Luxembourg vehicle.
Okay. And also, like, minimum investment, is there any target expected return, or?
I mean, the long-term target fund size is 1 billion Swiss franc, right? The long-term target, what we try to do on an annual basis, is about 15% return. So what this is a vehicle that is designed to compound wealth, right? So what we are not trying to shoot for is like the 30% plus IRR, which obviously would require substantial venture risk, which we are just not comfortable on. And so we are taking a little bit more the asymmetric risk return ideas. So limited downside risk, but significant upside risk. So this basically should actually enable people to compound in the long term. And obviously, the more the vehicle develops, right, and the older it becomes, we're now in the market for 5 years, right, the more vintage diversified it becomes, because the more early stage funds, etc., we will go into, and obviously, the more vintages you have.
And when was the fund launch, actually?
5 years ago.
5 years. And the minimum investment is?
It's we're a little bit flexible. Usually, it's about 1 million Swiss franc, right? And often it comes also compounded or basically consolidated from our partnership banks, but it's a little bit case by case basis.
Okay, thank you.
Sure. Any more questions? Great. Thanks so much for taking the time in the first place. If you have any more questions about Red Alpine specifically, or the products and the strategies more generally, feel free to stop by our desk, and it was a pleasure to interact with you.